Howdy, Jacob here. Today we're looking at AutoNation in the specialty retail industry. They operate as an automotive retailer in the United States. There's three segments: domestic, import, and premium luxury. 6.9 billion market cap, 10.2 billion enterprise value. So they do have quite a bit of net debt there. But the company is looking very cheap currently at 6.7 PE, just from that quick metric, with growth of the last 10 years being maybe 2 to 4% CAGR. So nothing too impressive, but definitely still some growth there. And we are seeing improved gross margin, improved operating margin, improved return on invested capital, where we're double digit the last 3 years, huge earnings per share, and income statement shows a humongous reduction of shares. So look at this: 117 million shares outstanding 10 years ago to 45 million. They reduced share count 60, whatever that is, 65% over a 10-year period. They're buying back shares, which, if they're at a very cheap price, that can be a great investment. Otherwise, buying back shares should essentially increase the price of the stock the same amount, due to the fact that market capitalization, all else equal, shouldn't be different. And then balance sheet does show quite a bit of debt here. We're looking at 4.3 billion short-term debt, 3.4 billion long-term debt, and 61 million cash on hand. So again, my calculation of earnings and free cash flow doesn't necessarily take the balance sheet into account. So you are going to have to balance out your maybe discount rate with either your discount rate or conservatism of the other assumptions to be able to be comfortable with this. So I always say, I mean, this is more, there's more cash than nothing, but you're looking at $4.2 billion due in the next year, 3.4 billion due likely after a year, under 6 years type of thing. And they only have 61 million cash on hand. So that is a lot of debt in comparison to cash. But let's see what it is in relation to earnings. So this year they only produced 300 million in free cash flow, but on a 5-year average basis, I mean, these could just be fluke years. This is post COVID, where the cars were actually, a used car wasn't depreciating like it usually does in the, you know 90 years. Well, I guess the Model T's been around for a while, but the used car industry was plateauing or even increasing in value because everyone needed a car before. I guess everyone wanted a car; they didn't really need one, but we could have just stayed from home. But it was interesting how much it went up. I don't know if it's going to stay at those types of levels, but even if we take a 5-year average basis, you're still looking at probably $700 million in production of free cash flow, which is still almost 5 times to get to long-term debt, inclusive of short-term debt. You're looking at about 9 years. So I don't know what they're gonna do to for this 4.3 billion due in the next year. If I wanted to invest in this company, if it looked cheap enough, I'd absolutely have to dig into. I would not personally buy this company until they either refinanced it, figured out a way um, to dwindle the short term debt down. Because again, that's 4.3 billion due in the next year, and they don't have free cash flow to pay for that. They don't have the cash on hand to pay for that. They're either going to have to refinance it or sell off assets, which you sell off assets can create a dwindling down effect that causes some crazy stuff. But it really looks like they went into debt to buy back shares, which, again, if those were cheap enough shares, that could be a great investment. But they also leveraged up the company to where now it's a lot riskier investment. And so I think we can start making some assumptions here and just keep in mind to do your own analysis to really look into that, how you're going to factor in that debt situation personally. So for me, I think growing with inflation seems pretty reasonable to me. I don't think it deserves an excess premium. I mean, you're looking at a pretty small range here, maybe 3.4, 3.2. in share change. So let's be reasonable. They don't go into debt. Maybe 50% of the free cash flow goes towards it. So let's say $69 million for 1%, and let's say they produced 400, 500 million. So we want 250. So maybe 4%. Let's do 3% because the company's really gonna have to focus on reducing that debt down. But I think 3% reduction is even still pretty reasonable. But based on how much debt they have, I will go for a 17.5% return because they have a lot of debt due soon. Um, I think the only reason I might want to do 15 is just to look into that debt some more. But I think I'm still comfortable with this because I want it to be a screaming buy. I don't want things to just be like, hey, this is a great company at an okay price. Buy it. I want the company to be screaming at me. I want the business to be screaming at me, and I just don't see that here with their debt figure going on. Um, and yeah, so it needs about 19% to get to the return we're looking for here. I think their reduction of shares is absolutely crazy. I mean, 15% reduction of shares, all else equal, should have increased their market capitalization that much. But again, if you're just going into debt to do so, that's going to cause a problem. You're basically, I mean, you are borrowing from your future self, so that's where it can become a definite problem. But I mean, not terribly far off. So I'll look into this situation. Hopefully, not too long. Hopefully, you enjoy the beers.